Alright guys, so this is your economic Armageddon once again, and before I start, I just want to let everyone know that I've been diagnosed with something called TMJ. It's a bit of a jaw disorder, so some of the words that I say, some of the sentences, it might slur, it might not sound very right, so I beg your forgiveness for this. But let's start, the show must go on. So the Federal Reserve has thrown cold water on the global economy and it isn't looking good for the stock market now. And if you thought rates would get slammed down to near zero, it's time to recalibrate your expectations. The Fed has officially cut interest rates by 25 basis points, but instead of seeing the markets rally, we are seeing a collapse in almost everything. Stocks and treasuries are plunging. The US dollar has risen to the highest since 2022. Why? Because Powell just signaled fewer rate cuts in 2025. And this is something we have talked about. Inflation is still a problem. And all the economic numbers, at least to the Fed, they are looking robust. So here's the deal. Rates are now coming down from 5.5% to around 4.25%. Money is getting cheaper, and like previous cycles, it's easy to assume the Fed will keep cutting all the way down to zero. But bear in mind these following statistics. CPI inflation for November has rebounded up to 2.7%. Prices are still going up much higher than the Fed's 2% target. However, core inflation, which strips away food and energy, is at 3.3%. So everything else, shelter and services, they are getting more expensive. Core inflation is the Federal Reserve's preferred metric. So this rising higher isn't good for the cost of living. In other words, rates have to stay higher for longer. Even if you aren't in the US, higher rates there affect everything. The price of gold, the value of REITs, and stock indexes, they're all falling for a reason. A real interest rate staying higher, well, that causes all risk assets to suddenly become less attractive. After the FOMC meeting, the Federal Reserve updated their projections of the Fed funds going forward, and it's not looking good here, guys, especially for investors like you and me who hold stocks. In September's projection, rates in 2025 were supposed to hit 3.4%. However, after the latest data, the Fed projects rates in 2025 to reach only 3.9%, and that's a half a percent more, which is extremely significant. So don't expect massive cuts of 50 points in any single meeting. From where we are now to 3.9%, there's only room left for one or maybe two 25-point cuts. The problem with higher rates in the US is the state of the national debt. In 2025, Trump is coming back to office, and as we all know, he has a ton of ambitious plans. He wants to cut taxes and bring industries back to the US. From semiconductors to car production, Trump wants stuff made in America, but realize he'll be doing this under a backdrop of higher interest rates. Powell cancelling cuts in 2025 just confirms this. This chart is the Fed's updated dot plot, and it tells us where rates would be in the next few years, and the numbers are startling. In 2026, rates could settle at 3.5%, but in 2027, we could still be in a world well above 3%. So 3 more years of higher for longer. This is the environment investors need to understand. This is the backdrop where Trump will be operating in. There will be more deficit spending over the next 4 years, and no matter how the Treasury borrows, they will be paying higher rates. It's important to remember the US is a net importer with a horrible balance of accounts. The current account deficit has reached a record high in Q3 this year. We are now at 310 billion further in the hole, and the implications, well, it's very serious. The US needs to constantly borrow money to fuel this deficit. No surplus is coming in to settle the books, and as this continues, more federal borrowing will be needed. So this is the baseline case. The Fed keeping interest rates higher is just going to compound the problem. They are sacrificing tomorrow's economy to fight inflation today, and that's the big trade-off we must all realize. According to the Peterson Foundation, US deficits will continue to soar despite low unemployment. From today until 2034, the projected deficit will average 6.3% of US GDP. And this isn't counting in Trump's future spending plans. And make no mistake here, guys, the spending is going to explode and hitting 7 or even 8% of GDP for the deficits is entirely possible. Trump's global tariff war is going to push US deficit spending to the moon.
Joe Biden has run up record trade deficits, also known as losses, higher than any president in history by far. These gaping wounds are costing our country countless jobs and trillions of dollars in wealth. One of my top economic priorities will be to stem this bleeding and put American workers on a level playing field. It's about time. And I must say, I did it 3 years ago, and they were doing great. But that's been blown out the window by the Biden administration.
Now, what Trump said makes sense. If you bring back US manufacturing and produce things locally, yes, the trade deficit will come down. However, he left the second part out to reindustrialize. Trump will have to borrow a ton of money to make it happen. And this can be in the form of direct payouts, lower taxes, or huge subsidies to companies. And with rate cuts slowing to a crawl, this will make borrowing costs stay stubbornly high. The US Treasury is trapped in a dilemma. And whether they borrow on the short end of the curve or longer dated bonds is going to be a nightmare. In November, the 3-month T-bill averaged around 4.6%. The 10-year note is at 4.4% as well. The Fed refusing to cut is going to put upwards pressure on short-term rates. And as Trump starts to borrow billions and trillions, that's going to make long-term rates stay higher as well. And if the money borrowed gets spent in a wasteful way, this would just compound the existing inflation problem. While Trump wants oversight over the Federal Reserve, we have all heard what Powell said time and time again. The Fed is going to remain independent, so he's going to resist calls for urgent rate cuts. During his statement at the FOMC, he reminded the world of the Fed's dual mandate. Unemployment has moved up but remains low. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. The Fed has written the playbook and we have to accept it. Unless the entire system collapses, unless all the banks start to shake, we will have higher rates for much longer. So we have to talk about the implications here and how the markets are effectively in spasm mode. Whether it's US stocks or global equities, everything is getting clobbered. The S&P recorded its worst day since the collapse in March 2022. The index lost nearly 3% in a single day, and it makes sense. Borrowing costs will stay elevated for companies big and small. Consumers will also get squeezed in their mortgages and credit cards, so spending is expected to stagnate or even fall further. And the same applies to other economies in the world, except the effects are magnified. Now, borrowing costs for them are rising, especially when it comes to their dollar-denominated debt. And almost immediately, the dollar index flew up even higher. We are headed back to the 2022 highs. As the dollar gets stronger, it creates all sorts of problems in the global economy, especially for emerging markets. So if you're invested in global equities, there's a reason why they are falling harder than US stocks. It's all because of the US dollar effect. Now, during the FOMC meeting, Powell gave a forecast of things to come. Future cuts would require fresh inflation progress. And if it doesn't, we'll only get too many cuts in 2025. But we have to ask ourselves a realistic question. How far can inflation come down from here? The biggest threat to this, ironically, is Trump's tariff war on the world. And let's recall one simple fact. The US imports far more than what they export. By slapping a tariff on China, Mexico, and Canada, the US is rolling the dice and countries could very well retaliate on the US economy, which would spark higher inflation. And let's look at China first. US suppliers still rely a lot on Chinese goods. While the direct supply of Chinese imports is going down, something else is rising. Suppliers to the US still rely on Chinese goods. It's hovering at around 16%. However, the cost will be higher because these are coming from middlemen companies. Even if Trump slaps Beijing with a 60% tariff, it doesn't mean Chinese products will stop entering the US. It still would, but under a different label and at higher costs. And what goods would be involved? Well, most of them are consumer goods that people like you and me consume, stuff that you can find in Walmart. And these 5 goods make up the majority of all Chinese imports into the US. 76% of smartphones comes from China, portable computers 78%, lithium batteries at 70%, and even toys at 77%. So Christmas shopping in 2025 is about to get more expensive. And once again, I'm not saying these goods won't reach the US. It most definitely would. However, the supply chains, they're going to get longer, resulting in higher prices. But what about Mexico and China? I mean, Mexico and Canada? Well, Trump plans to hit them with a 25% baseline tariff as well. Now, how would that affect inflation? Well, in a massive way, and there are big consequences. 400 billion in machinery and transportation goods, 145 billion in mineral fuels, 85 billion in manufactured goods. And if you combine all this, it's nearly 900 billion worth of imports from Canada and Mexico. And that's why the Federal Reserve is slowing down their interest rate cuts. They have determined Trump's policies are more inflationary than deflationary for the next 4 years. And it's a very simple calculus. If somehow the US manages to manufacture everything in house, the cost of production will be so high that inflation will spike up. An iPhone could cost 2 or even 3 grand now. And if that doesn't happen, imports to the US will also cost more thanks to the tariffs. Importers will pass down the additional costs to the consumer. Or, as we mentioned before, third party suppliers will simply extend the supply chain and take their pound of flesh. Either way, the trade war is very inflationary. And when you put everything together, it's not a good situation for the US. Sure, high interest rates can help put a lid on inflation somewhat, but it will come at the expense of the national debt. But the debt crisis isn't in the purview of the Federal Reserve. Powell's mandate has been very clear from day one: keep unemployment as low as possible while bringing inflation down to 2%. In 2021, the net interest cost on the debt was only $350 billion. In just 3 years, this amount has ballooned to over $880 billion. It's a very serious problem that's going to get worse in 2025 and beyond. Even though we are seeing a market collapse, the bigger danger down the road is a debt default. Now, we have no idea how soon it might come, but the longer rates stay high, the worse the situation will be. But let me know what you think. Will interest rates stay higher for longer? And will it take a recession for Powell to drop rates down to zero? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.